Morning, everybody. Welcome to the Sports Philanthropy webinar today. My name is Roy Kessel. I'm the founder of the Sports Philanthropy Network, and we're excited that you were able to join us today. It's great to have with us Jay Pollack from Laurus Strategies for Wealth, and Jay is going to talk about some of the best ways to use life insurance policies and other strategies to create a sustainable stream of revenue for nonprofits. It's something that people often don't look into, and before we go around and do that, get started with Jay's presentation, I want to give everybody an opportunity to introduce themselves. And so we'll just go around. Brandon, you want to jump in?
Hello, I'm Brandon. I'm a student board member of Boys on the Right Track, a leadership skills program in Buffalo, New York. I'm also planning on opening my own sportsmanship basketball organization in the future.
Okay, thank you. Doug? Is Doug there?
Good morning. My name is Doug
There
Garner. I am the Director of Adaptive Sports at University of Texas Arlington and head men's wheelchair basketball coach.
Okay, great. Kayla?
Good morning, everybody. My name is Kayla Bradham. I'm in Milwaukee. I am the Vice President of the Sports Philanthropy Network for Community Development. I am a high school teacher, and before the calls began recording, I heard somebody speaking about having 5 children. I have 8. My oldest just finished her first year of college at home, and I have 1 on a gap year and 6 somewhere between kindergarten and a junior. My life is hopping.
Wow.
So
wow.
Kayla is our VP of Community Development, and
that's awesome.
She does a lot of work with the organizations in the network and reaching out to different groups like that. Obviously a big help. I see Vinay just jumped on. Vinay, you want to introduce yourself?
Yeah, hey guys. Sorry, you're going to hear some background noise here. Yeah, Vinay, UpMetrics. We work with nonprofits and funders around impact analytics and fundraising. Glad to be on. Thanks.
Terrific. Well, on behalf of myself and Kayla and the Sports Philanthropy Network, we're glad everybody's with us today. I know Jay's got some fantastic slides and information, and we're going to be happy to have this available as a resource to share with everybody in our network. Jay's graciously agreed to give us some time this morning and walk through some of those strategies. Colin, I didn't let you introduce yourself, so before we let Jay do his introduction, why don't you jump in?
Hi, everyone. My name is Colin Aubin. I'm a managing director for the Guardian Life Insurance Company of America and partners with Jay, and appreciate the opportunity this morning to get on and hopefully provide what will be some very useful information for the network.
Terrific. Thanks for being here. All right, so without further ado, we're going to turn it over to Jay to give us his insight. What I encourage you to do is, if you have questions, please feel free to jump in, or if you want, you can drop it in the chat and I can jump in when we get a break. So Jay, thanks for being here. We look forward to hearing some of these great ideas.
Thank you. Thanks for inviting me. Thank you for inviting me. I really appreciate it. And Roy is right. If there's a question, I'm not one of those who's I'll wait till the end for your question. If you want to say something or not sure about something I'm talking about, feel free to jump in at any time and go ahead and ask me the question. So I have what I call a creative life insurance practice. And so I show clients and their advisors how to use life insurance in ways they never dreamt possible. And the philanthropic world is no different. I mean, we do creative things in this arena. We've been doing it for a long time, and it's a very unique space. And so there's a lot of fun in doing the planning. But a lot of times people don't think about life insurance as in the charitable world. Everyone is focused on all sorts of other things. So why life insurance? I mean, it's a really versatile gift. It does all sorts of things. It allows a larger, more substantial donation, most of the time on the back end, but sometimes on the front end, and we'll get into all that later on. And donors like the idea of a regular contribution that goes to a much bigger amount later on. So that's all about leverage. It's really about, if I put in $1,000 a year for 10 years, the charity might get $100,000 somewhere down the road. And there's very few, if any, other assets where that works like that. So it's a very unique thing. And we're going to talk in a lot more detail about the different ways to do this as we go through the presentation. The benefit to charity is it requires a very small amount of administration. There's not a whole lot to do. I mean, once someone either changes a beneficiary, gives a policy, makes a new policy, any of those things, once it's set up, it's pretty much set up. So it's not a lot of work on the charities part, and the charities that we've done work with really appreciate that once it's almost, it's not really one and done, because there are some things that need to be done, but it's not as onerous as some other forms of contribution, real estate, appreciated property, things like that are much more difficult to account for and keep track of. And then there's the death benefit. The death benefit with most of the policies, well, all the policies we use are guaranteed. I mean, it's going to be there. It's going to come. You just don't know when. But it's a large amount of money, and there's enough people doing this. The law of large numbers, you're able to plan for cash flow in the future as because people, everybody dies. That's one of the unique things about life insurance as well. Eventually it's going to result in a payout. So those are the basic reasons that we find life insurance to be an extremely valuable asset for a donation in the philanthropic world. Now, there's a number of different ways to do this. I mean, and we'll go into detail on all of them. Sometimes it's just as simple as changing the beneficiary. Just change the beneficiary. I name the American Cancer Society. I name my private foundation. I name my donor advisor fund. I name any of those type of things as the beneficiary. And we'll come back. We're not going to go through the details right now, but because there's subsets to all of these. We can have existing life insurance, and we can gift that and say, I don't need it anymore. My needs have changed. So I'm just going to give the policy that I was using to make sure I can send my children to college. Well, they're all through college now. I don't need that anymore. I'd love it to give it to my alma mater or one of the other alma maters, or the school where I played baseball, or anything like that. So, you can do all those. You can do all that as well. We can also start from scratch from brand new insurance. We're gonna let the charity own the coverage. We're gonna make the premium payments. We're gonna do all of those things, but we're gonna start from scratch. So there's nuances to all of these. And they all have different tax consequences. They all have different liquidity issues and pluses. Some of these are today versus tomorrow, but I like strategies that are not one-trick pony. I love strategies where there's a current use for the charity, and there's an eternal use for the charity. It's both. It's not just one. So there's four major ways, and we talked about them briefly. The charity is the beneficiary of group term insurance. Most people don't think about that. A lot of my clients are executives in larger companies, but even smaller companies. As part of health insurance, they have group term life insurance, and there's tax consequences to amounts over $50,000, and we'll come back and talk about it. I have a lot of clients who, their family, they've done their planning in other places. So what an easy way to make a future gift to a charity. It's one piece of paper and you're done. You can take your own personal insurance and put all or some portion of any policy, and you can change the beneficiary to the charity. Again, one piece of paper, easy. You gift an existing policy like we talked about before. There's a lot of nuances to that, and we'll spend more time on that probably than anything else as we move forward in the presentation. And we could also create new insurance owned by the charity, and the contributions are made by the donor, but the charity has all the control over the policy. And the donor is just making annual gifts to pay the premium on that. We'll come back to all these things. But these are really the four major ways. And there's some other more sophisticated strategies we'll talk about at the end, but that's beyond the scope of today's presentation. They're out there, and we'll spend the last couple minutes on that, but that's not going to be the main focus of today. So as we mentioned on the group term insurance, simple, provided by the employer. A lot of people, you'd be surprised, don't even know that if they have group term life through their employer, that if it's over $50,000 of coverage, that there's a tax. It's called the Table 1 tax. And it's not cheap, especially for older employees, because it's every 5 years there's a scale of cost per thousand. But again, it's really simple. And if they name the charity as the beneficiary, let's say over 50,000, maybe the whole thing, they avoid that income tax on the higher amount. And it's a great way to create a social legacy. Now, to be perfectly honest, in all the years I've been doing this, and that's a lot of years, I don't need one hand to count the number of group term life insurance claims that I've had. Okay? Because most people aren't dying in their working years. I mean, they're just not. So and most people don't continue their group term life insurance when they retire. So it's not a huge percentage of the life insurance cases that charities would see. But it is simple, and it's people do die. So, every once in a while, there's a huge amount of money that goes to a charity. And again, this was really simple. I just changed my form with my employer, and that's the end of it. And there's obviously flexibility. They can change their mind, put more in, put less in, take it away. Very simple to do. You can do the same thing with personally owned life insurance. You just name the primary beneficiary as the charity. You can name the contingent beneficiary as a charity. I've got a spouse as my beneficiary, but if something happens to my spouse, then the charity becomes the beneficiary. Again, you can do percentages. You can do all or a smaller percent. And again, it's flexible. This is not irrevocable, although you can certainly make an irrevocable policy beneficiary, but we'll come back to that a little later on. Most of the time, it's not irrevocable. There's really no tax advantage for the donor here because they're just changing a beneficiary. The charity has no control. If it's a cash value policy, there's nothing they can do for it. Today, it's kind of like we tease some clients about certain types of life insurance used for estate planning. Basically, they're waiting around for you to die. That's basically what's happening when you just name the beneficiary as for the policy and give the charity no control of any of the living benefits. So transferring a policy, now this is always more interesting. So I have an existing policy, I don't need it anymore, or I've made other planning consequences, and I'd like to give it to the charity today so they can have the benefit of that. Now, it can be term insurance or what we call permanent life insurance, which has cash value and living benefits. It can be either or. If it's term insurance, that's pretty simple. They just pay the premiums every year. Charity owns the policy and has the death benefit, but there's no current tax break for the donor. Again, nothing happens until they die. But most of the time we're doing this, it's cash value policies. So I take a policy I've been putting money into for years. It has a bunch of cash in it already, and now I give it to the charity. So they have a policy with a lot of money in it today and an eventual higher death benefit available to them somewhere in the future. So there's a tax deduction for the donor because of all this cash that's in the policy. And by the way, one of the things that's changed as part of the CARES Act they've changed the charitable donations for cash. And so cash value is considered cash. So it used to be a percentage of your adjusted gross income. At least for 2020, that's gone. You can give away 100% of your adjusted gross income to a charity as long as it's a cash gift, and life insurance is considered is considered a tax gift. So that's a cool little opportunity. They may extend it to 2021. We don't know yet, but we know it's available for 2020. So in that situation, there's ongoing premiums. Those are gifts made by the donor. You could also do what's called reduce paid up. I have $1 million policy. It's got $100,000 of cash in it, but I don't want to make any more premiums. I just want to give the charity $100,000 and the eventual death benefit. You can do something called reduce paid up. I don't want to pay any more premiums. There's $100,000 of cash. Well, that $100,000 buys me $472,000 of death benefit forever with no additional premiums. So the charity would have $100,000 of current money they could get their hands around, and eventually a death benefit of $472,000, and the donor is not making any additional gifts. That doesn't happen very often. Typically, if they're going to do this, the idea is to keep making the premium payments and keep growing the amount for the charity, take an annual deduction, growing the death benefit so that it becomes a sizable gift down the road and currently for the charity. Because every year I make another $10,000 contribution to a mature policy, the cash is going up by at least $10,000 and typically substantially more than that. So that's a powerful, powerful gift for the charity. We're seeing more and more of this than we ever used to, and that is starting from scratch with the charity. So you're gifting money to the charity. The charity is the owner and beneficiary of the policy, so they have complete control from day one. Every year, the premiums being paid, that's a gift by the donor. Annually, they get that tax deduction right off the bat. The only thing we have to be careful of is insurable interest rules, because when you buy life insurance, there's an owner who's not the insured, there has to be some insurable interest. Why is the charity the owner and beneficiary of a policy on Jay Pollack? Well, if I'm an existing donor, that's in most states, Illinois being one of them, then I have insurable interest. I've been making gifts to the charity for years, and therefore, I want to continue making those gifts, and I'm using life insurance to do that. There should not be a problem with that. But every state has their own statute about insurable interest.
Hey, can I jump in for a second here?
Sure.
Because I think that's really a critical point for people to understand, which is, right, I can't just go and buy, let's say, an insurance policy on Donald Trump or on any politician or president just because I want to have that, right? As you said, there's got to be the concept of insurable interest. Let's take a step back for people that aren't familiar with that and maybe just explain what that really means. And then I think there's a few other follow-up questions in terms of, I know it's different by state, but one of the things that you mentioned was the fact that you're a longtime donor. And I'd be interested to get your feedback as to, does that mean that a new donor couldn't do life insurance? And where is that line? How long would they have to have been involved with the organization before that would constitute insurable interest?
So I'll start at the very first thing that Roy asked. And so how did this all come about? Actually, it was part of the Armstrong Act in 1906. Because what was happening with life insurance before then is I could have bought a policy on Donald Trump. Okay, they were actually using life insurance as a wagering to see if people would live or die. And there were obviously people didn't like the idea that someone could benefit from their demise. And so there was this outpouring of very upset people about this. So Congress convened, investigated this, and because of they created the Armstrong Act, and the major component of the Armstrong Act was insurable interest. So Roy and I are partners. Well, we can certainly buy insurance on each other. There's insurable interest. But if I don't know Roy, other than I met him today on a video call, and I try and go buy insurance on him without him knowing about it, then there's no way that we can do that. So that's how it started. So it's been around for a long time now, 115 years roughly. There's no court case that I'm aware of, Roy, that says exactly how long you have to be a donor, or even if you have to be a donor. Again, most states will consider making life insurance donations to a charity through new policies a basically de facto insurable interest. Most states have somewhat lenient, not lenient is not the right word, flexible provisions on insurable interest when it comes to charities. But not all states do. Some use the same criteria that we'd have to use, personally or corporately. And we'd have to check. But I'm not aware of any court cases that literally say, well, if you've been giving for 5 years, then you're okay. But I can't say that I've investigated it. I've never had a situation where it came back and said, no insurable interest, sorry, we can't do this. That's never happened. So
whose
go ahead, Roy.
decision is that? Is that the insurance company that's issuing the policy, their decision to determine whether you do have an insurable interest?
Well, it would be their legal department would check the state statute and see if there's something that they need to look into more carefully. And that's happened once or twice to us where they've said, we got to look into this. And both times they came back and said, it's fine, it's okay. So it's up to the statute, and all major insurance companies have large legal departments. And there's always somebody who specializes in the area of insurable interest.
Okay, thank you. Thank you.
Let's see here. So this is kind of it's getting a little more on the sophisticated plan, but we do a fair amount of this still. What's called a wealth replacement trust. So clients will set up an irrevocable life insurance trust. The reason typically is they want to make large donations to charity, either currently or at their death, but they don't want to take away from what they're leaving for their children, grandchildren, or any other beneficiary that they feel is important. So instead of making the gifts of insurance to the charity, they set up a trust, they buy insurance for themselves, and they make very large annual gifts or gifts at death to the charity. And they can do that because if they're going to give away $1 million when they die, it's okay because I've got life insurance to replace that $1 million. I bought $1 million policy for $10,000 a year, and I paid in for 20 years, and now I die, and the charity gets $1 million, and my trust gets $1 million, and everybody's good. Certain other more sophisticated strategies needs that irrevocable life insurance trust to make it work, but we'll talk about that in a second. That's again more of the sophisticated kind of planning. Use this for private foundations. Again, other more sophisticated planning subjects. And something also along this line is something called private placement annuities. We've been seeing more of this. It's not technically life insurance, but there are some very interesting annuities out there. And annuities don't have quite the same tax benefit as life insurance does, but for a charity, it doesn't matter because charity, obviously, most are either 501c9 or other whatever under the tax code that lets them get benefits tax-free. So the fact that the annuity is not as tax efficient is not necessarily a downside for using these private placement annuities. They're kind of cool. They're institutional grade, lots of different investments, large amounts of money can be transferred, and we're seeing more and more of this in the last few years. We're seeing more and more of this. Sure, many of you have heard about Charitable Remainder Trust. We're just going to touch on Charitable Remainder Trust and Charitable Lead Trust. We talked about appreciating assets, so I bought a painting for $100,000, and now it's worth $1 million. So if I sell it, I have to pay capital gains on $900,000, but I can donate it to a Charitable Remainder Trust. The charity now can sell it because the charity is the beneficiary of the trust. They can sell it. There's no capital gains, and I get paid out on the full $1 million, a lifetime income, but the charity owns the actual principal in the trust. So there's a lot more to it than this. In today's low interest rate environment, we're not seeing a lot of it because the amount they're getting as income is not really very high. Interest rates go up and down. So I used to do a lot of work on this in the 90s and early 2000s using Charitable Remainder Trust. We did quite a few of these. Charitable lead trusts are exactly the opposite. Client owns the asset still, but they're giving all the income to the charity. So in the same way, they sell that painting, they have $1 million, charity gets 5% a year or $50,000, and they still own the $1 million that's inside the trust. Good tax consequences for the donor in both of these situations. And you know, we do all sorts of sophisticated planning. I mean, 90+% of your gifting from donors will not be this sophisticated. It'll be more what I'll call vanilla life insurance planning, but all of this exists. These are all things that can be done. And what we found is substantial donors are willing to talk about sophisticated planning and what they can do for their favorite charities. And these can be very big numbers. These can be very big numbers. I mean, all the major college foundations, the Harvards, you know, which have billions of dollars. I mean, there's tons of life insurance in those foundations for the big institutions, tons of it. So that's pretty much the presentation for today. That's just what I'll call a primer on using life insurance in the charitable world. And I thank you again. I'm happy to answer any questions we might have.
I think if, you know, from my end, when we look at this, one of the challenges that a lot of organizations have in their fundraising is they really want to develop that pool of funds that we talked about to be able to sustain an organization, right? And it's like the annual campaign is really designed in a way that focuses on how can we live today, right? How can we pay the bills right now? How can we make our operations viable for 2020, 2021, right? Maybe you're really living, in a sense, paycheck to paycheck. And it always surprises me that when you look at the planning options for many of these larger, you know, even smaller organizations that want to create a sustainable impact from their organization, that they don't try and add in some of that effort, because I think that there's a lot of people out there who, as you said, may not have the resources right now to make that financial contribution. Let's say as they are getting older, right? They may not want to take cash out of their current cash flow, which is usually reduced at that point in their life, and make a direct donation, right? What they're trying to do is look at it and say, how do we make a long-term impact? And if we've got life insurance and we're, you know, in our 70s, in our 80s, and we believe in a particular cause, while we can't support it well financially right now, we may be able to convert some of these policies. You know, from your experience, when people are looking at existing policies, what's the best way for them to go through that conversion process?
Typically, with existing policies, the best way to do that is to the most efficient way to give the charity some current income, and that eventual larger amount on the back end is to gift the policy. And the gifting is not very difficult. There's a change of owner and change of beneficiary to the charity. The insurance company will typically provide what's called a 712, which values the policy, so the donor knows what his charitable deduction will be. And so there'll be a big deduction up front, and then all the annual premiums going forward are easy. Those are annual deductions. And that's typically what we'd see, Roy. We'd see something that looks like that.
Okay. And
I'll give you one cool story. Malcolm
Yep.
Forbes, everyone knows who Malcolm Forbes was. His estate plan was basically, I don't know, he was worth, this goes back 20 plus years, he was probably still worth $100 million. And his estate plan was really simple. His estate, he went out and bought $100 million of life insurance, because his plan was, I'm going to spend as much money as I can having a great time, and whatever's left is going to charity. And it's okay because my family, my children, my grandchildren, all the people I care about are going to get $100 million of life insurance. So I'm not depleting my estate at all. I'm going to have a great time. Charities are going to benefit. Everybody wins. IRS loses. That was basically he hated paying the IRS money. He'd rather, and that's the thing, by the way, in your world, which you guys already know this. I tell clients all the time that an estate tax is voluntary. Because the simplest way to avoid an estate tax is to give whatever amount that I would owe in estate taxes to charity. And I've wiped out my estate tax. Because and that's the way it works in this country. You can avoid the estate tax if you are charitably inclined. Some people become charitably inclined when they hear that. I mean, they may not have been thinking philanthropically, but when they see what they can do, and it's kind of an education process, they're all for it. I mean, I'd much rather give my money to American Cancer Society or my college or a donor advised fund or anything like that than to give it to the IRS. So there's a very strong undercurrent in our society, especially among the high net worth, that the IRS is the last person they want to give the money to.
And I think that brings us to the other sets of charts and everything you had, which illustrate the fact, in my past life practicing law, I did a lot of work representing clients and doing estate planning work. Many of them not even getting to the point of this level of sophistication where they had enough resources. At that point, they were just trying to avoid the basic taxes and everything else, for the spouses and the second to die in a couple and things like that, which now with the new exemption limits and things have really taken that issue away for most families, overwhelming majority of the families. But the challenge that people often don't recognize and plan for is that almost all of this type of work and estate planning work is entirely form over substance. You can do the exact same thing in a way that gets you the tax benefits and gets the deductions and gets the money to charity, or you can do the exact same thing in a way that doesn't. And so as long as you just follow those dotted lines and connect them, you're going to get the benefit. And there's really, shockingly to me, where people don't do some of those steps because they're not that difficult to do. Somebody comes to you and gets good advice on what's going on. It's something that's been done, right, hundreds of thousands of times, millions of times, things like that. And so the plan is, let's sit down with somebody like Jay and let's put this plan in place because we've got assets. Maybe our kids are grown now. Or maybe we want to make that investment in smaller steps from the beginning, but leave that as an endowment for the organization as time goes by.
Absolutely. Back to the state tax is voluntary. And so it doesn't take, Roy's right, it doesn't take a whole lot to circumvent it in a favorable way. I don't mean that in a bad way, but most of us, most people I talk to, given their druthers, would rather give their assets to anybody but the IRS. So if we can show them ways to do this and benefit their favorite charity, society in general, then 9 out of 10 are more than willing to look at that.
Yeah, and I think that would be interesting to see, Jay, if you had a few other examples. You used the one example in the presentation about the artwork where that had appreciated from I think you said $100,000 up to $1 million, when they donated that, so they could make that donation. But what about some other asset classes? What are other popular classes that you see in that process?
Well, it could be almost any appreciated asset because what typically happens, it could be real estate, it could be a business interest, it could be IBM stock, it could be any of those things. Because typically what happens, let's use real estate as the most complicated. Well, if I make a gift of real estate, appreciated real estate, the charity's not going to keep the real estate. They're going to sell it. The whole point is for them to sell. They don't want to be in the real estate business, right? That's not what the charities want to do. So they're going to sell it. They're going to have cash to do things with. And the benefit goes to the donor because, again, it's $1 million of real estate that I bought for $100,000. It's the same thing. I owe 20% capital gains plus state taxes on $900,000. That's taking a chunk out of my money left over to generate income for retirement. So would I rather have the whole $1 million and get 5% income on the $1 million, so get $50,000 a year forever, as long as I'm alive, as long as my spouse is alive, can design that any way we want to. Then the charity has $1 million of cash. They sold the real estate. So, but it's true for any asset. Now, if it's a stock portfolio, the charity could decide to keep the stock portfolio and not necessarily sell it to cash, and therefore it could appreciate even, and which is a way for the donor to get even more income if the portfolio increases. So these are all nuances of the planning, but there's a huge amount of charitable planning that goes on for appreciated assets. Pretty much anything that can be appraised, and anything that has basis that you bought it for can be used in that fashion.
Are you seeing a lot of people in today's world coming and trying to create planning options around Bitcoin or any of the blockchain technologies?
Well, Bitcoin, it's so volatile. I have not seen anything in that arena of donating Bitcoin, because it can be worth 100,000 today and 40,000 tomorrow. I mean, it's just so up and down. But I mean, people that got in early. I mean, Colin and I have a partner who got in really early. I mean, when it was like $16, and he could have sold it for. Now he's young. He's probably not going to go giving it to charity in his 30s. But if someone did that in their 60s and had timed it right, they could certainly do that. But that's a very difficult timing issue because it is so volatile from day to day. I mean, it can go up or down 10% easily in a day. But it would be the natural thing if you bought it low and sold high, and it certainly could work. I don't know why it wouldn't.
So the other interest that you mentioned that raised a few questions for me, you talked about business interests being put into one of these trusts. So what risk would the nonprofit have if there's things that go wrong in that business, or is that all then going to be contained in the trust to insulate the nonprofit?
Well, typically they would do the business interest for a charitable lead trust as opposed to a charitable remainder trust. So the income would go, and so if I own 100% of a company and I give 20% and put it in a charitable lead trust of a $10 million company, so there's $2 million, and let's assume it's a pass-through as a K1, so whatever the K1 generates for 20% interest would go to the charity every year. So what's the data? Well, business goes bad, then there goes your cash flow. But typically people are doing it for planning purposes, and they have confidence in their business. It's going to do well. It's going to be growing even. And by doing this, they get the growth of that 20% interest out of their estate. It's a freeze technique for the donor and a great source of cash flow for the charity. And because in 10 years, they get it back. And now maybe it's worth 15 million instead of 10. And that 20% of that, the $1 million growth, they don't have to, it's out of their estate. So,
yeah, and I just know that the risk aversion obviously is not wanting to have to deal with any of the potential drama that occurs in any business environment, whether it's lawsuits or partnership disputes or anything else like that. If they're just getting essentially the residual income that's coming out of it, then that's attractive obviously to a nonprofit.
Right, and there's the UBI issue of the business interest of, depending on how they did it, they use qualified plan money to do that. I mean, there's a lot of different ways they could do it. And that's something we didn't really touch on, and it's not so much a life insurance issue, but, the charitable deduction, at age 70 and a half with your required minimum distributions going straight to charity. I have clients who have done that. They've actually used that amount to go buy a life insurance policy in the charity. So that's combining two really unique philanthropic planning techniques into something that overall is much bigger for the charity.
So why don't we walk through that a little bit more for those that maybe on the call now or are going to watch later that aren't familiar with the required minimum distributions and how those work and how that would connect up with the purchase of the policy.
So historically, once you hit age 70 and a half, you have to start taking money out of your 401k, your IRAs, your profit sharing plans. The intent of all these plans were for retirement. So the government didn't want you just to leave this money alone forever and let it to grow to some huge amount. They want to start getting their income tax out of that. So at age 70 and a half, you have to start taking it based on who you're, different rules over time, but basically husband and wife typically, joint life expectancy. If I got $1 million at 70 and a half, I had to take out roughly 4% or 40 grand. And that number escalates as we get older. Part of the Secure Act that was passed at the end of last year moved that back to 72. And they also made it clear on what's called the qualified charitable deduction, that what I can do is I can use that required minimum distribution at 72, and I can send the money straight to charity. And I get an immediate tax deduction. I don't have to take that required minimum distribution. Let's say it's that same 4% of $1 million, that same 40 grand. I can just give that 40 grand directly to charity, and I get a $40,000 tax deduction off of my required minimum distribution. So I owe no tax. I owe no tax on that. Now, charity now has $40,000 cash. That's the simplest way. That's what happens most of the time. But a couple of times we've run into situations where we talked about life insurance planning and said to charity, how about taking the 40 grand and putting it into, let's call it a short pay policy, 10 years of premium, $40,000, 400 grand, buys $1 million policy. And I have access to hundreds of thousands of dollars of cash during the 10-year period where it's accumulating. And at the end of 10 years, I've got $1 million death benefit, maybe a little more. I've got $400,000 or $500,000 of cash I can use for that annual thing that I need so I can run my charity, because I need annual money too. I can have the best of both worlds. I'll still have the amount of life insurance above the cash value, but I can use the cash value while, for my day-to-day expenses and goals of the charity. And it all came from the required minimum distribution, because that's, the only requirement is you have to be 70. Now it's 72. It was 70 and a half. Now you have to be 72. And the limit, I believe, is 125,000, if I recall correctly. That's the most you can do. Now you need a lot of money in IRAs and 401ks to have a required minimum distribution above $125,000. You either got to be very old or you have a lot of money at 72. That's probably the equivalent of $25 million plus.
Yeah, that 125 is not making much of a dent in 25 million then.
No. Well, that's a cool thing. It keeps growing. So the minimum distributions get bigger because there's just less life expectancy, and you hope the portfolio is growing by more than the roughly 4% that you need to take out at 72. So that, that whatever I said, 25 million could be 30 million at the end of 10 years. And then it was 5%. So now it's 150,000 to charity, then you're above the limit. So then you can carry forward, and now we're getting really techie here, but there's all sorts of things you can do.
Yeah, it's interesting to me how for so many years it was 70 and a half. You wonder where they came up with that kind of number. It's like you had two people saying it should be 70, it should be 71, and they're like, oh, screw it, we're just going to split it in the middle and come up with, I don't know what that could possibly tie back to, and maybe there is some history that behind that number.
Well, it was because of the 401k. There were no 401ks. 401ks didn't even exist until the 70s. They didn't exist. So there was no, the IRAs didn't exist until the early 70s. So, people had pension plans. Well, pension plans don't need required minimum distribution. You're getting annual benefit. You pay tax on it every year. That's simple. So they have to do something when the shift went from defined benefit pension plans to defined contribution, 401k and profit sharing. They have to do something to get their money. That's how they pick 70 and a half though, Roy. I don't know if there's a story behind that or not. I've not heard it if there is, but maybe there is. I don't know. Maybe
it just seems like not something you would actually land on arbitrarily. I don't know how it must have had something to do with some type of actuarial tables or something to come up with that number. I can't imagine.
Now I'm curious, so now I'm going to have to look when we're done today, see if I can figure out how the 78 came to be.
So as you look ahead and you know, we're now going through this COVID crisis and everything that's going on, are you seeing people being more reluctant to engage in this kind of planning because they're uncertain as to what their own future is going to look like?
I think it's too early to tell. I'm not quite sure yet. What typically happens after crises like these, and I'll go back to the meltdown of 2008, 2009, there's always a flight to safety. Now, what they say is interesting. I've been reading some things saying for the first time ever, people weren't being stupid. They didn't sell when the market crashed back in March like they did in 2008. 2/3 of the people did not sell at all. More people actually went into the market than got out of the market. That's never happened in a crisis before. So, you know, it gives me confidence that people understand this is something, hopefully, that's temporary and things will go back to normal, whatever that is, sooner rather than later. But again, with a flight to safety, I think this kind of planning in the philanthropic world will be stronger than ever, because this is a pretty safe way to do things. And again, because it's in the future to a large part, they can feel good and not really affect their life if they're worried about it today.
Yeah, I think one of the struggles we've seen with so many organizations is people can react to an event that's a crisis, right? So whether you talk about 9/11 or you talk about Katrina or you talk about earthquakes or anything else, right? They end up being discrete events that have an endpoint, right? The damage may go on for a long time, but the event itself is over. I think one of the big struggles we've seen with many organizations right now is we're in the middle of this and we have no idea how long it's going to go on, right? Depending on what you believe, we may be in some form of restriction for the better part of the next year until there's a full-scale vaccination and antibody tests and all of that research and things that are done. On the flip side, you've got groups that are expecting some of the sports to start opening up in June and start competing even without fans, but I wouldn't classify that as normal. And so now everybody's trying to figure out, what does this mean for me? How long am I going to be without fans, without income, without regular ability to go out and earn what I need to earn? And I think that's really the challenge as you look at so many of these groups and say, you know, how can you make plans effectively when you don't know what's going on? And it relates on both sides of the coin, because as a nonprofit, you don't know what your donors are going to do in reaction to this type of scenario. So even if you were pretty far along the path of creating one of these unique strategies you described today, right? If you hadn't completed it on March 11th, you know, and everything blows up at that point, now you're sort of in a holding pattern. And, you know, from a nonprofit's perspective, they may have other donors or funding sources or lenders that would help them monetize those commitments once all the documentation had been completed.
Right.
But right now you're in this holding pattern, and so you're kind of reluctant to ask people for money. Even when you ask, people's capacities may be dramatically reduced. And then now, how are you going to integrate that planning? You know, so outside of the nonprofit space, what have you seen just for your own clients in terms of what their reactions have been to this crisis?
Well, I think the overall reaction is people more than ever are interested in making sure their planning is the way they want it. Because sometimes it takes a crisis like this to get people to say, oh, I better check to make sure that everything's the way it's supposed to be. So that's what I've been seeing. And I mentioned to Roy before we came on the call that we had just sent a blast out to our top clients about one of our major insurance companies, how well they're doing, and they're unaffected pretty much by the COVID crisis, and your cash value is still going up every day, and none of that's changing. You have to look at the Wall Street Journal to see how your cash value is doing. And we got a tremendous response, because the last part of the note was, hey, if you got some time to talk, you want to set up a chat, just give us a ring and we'll set something up. And within the first 24 hours, half of the people we sent that blast out to contacted us and said, hey, let's set up a call. Let's set up, something, or as soon as this is over, let's get together, And so I would think that's transferable to the philanthropic world as well. I would think that people are if they were charitably inclined, they're not going to not be charitably inclined anymore. And the government's made it easy. I mean, they put that $300 above the line deduction, which is not super helpful for anything we're talking about. But still, there's $300 that everybody can give the charity now, and not even if they don't itemize, they can still make that gift. You can do 100% of adjusted gross income for cash gifts. So again, not appreciated assets, but for cash gifts. Well, that's kind of cool, because it was usually limited to 30% or 50%, depending upon the entity. So they're trying to make sure the charities aren't being hurt. And I think the word is getting out to clients. They still can do their planning, even in this crazy times we live in.
Yeah, I think that there's so many interesting ways to approach it. And if people take the time and the organizations really focus on that, it's always interesting to me to look at. Every organization wants money, and yet it seems to me so few of them utilize this type of expertise and resource that you're describing as a way for them to really build up the financial strength of their organization.
Right.
I know, I think the ones that should be a particular interest is some of the ones you describe, where it basically helps convert the policy to an asset for the nonprofit right away, where they can get that gift, and then it's truly usable almost immediately for the nonprofit.
Yep, for sure.
And
for sure.
Well, Jay, I really want to thank you for coming on with us today. It was terrific insight, and I know that we've got a lot of people that are going to go back and watch this, and I appreciate everything that you put into that. Those slides are going to be terrific to be able to share, because they really illustrate how many ways there are to, no offense to Kayla's cat, but to skin the cat and to, make a dent on improving the financial stability of an organization, because everybody that sets it up, nobody really comes out and says, I'm going to set up a charity or a nonprofit for 3 years. Right. Other than these immediate relief funds that relate to one specific crisis. But generally, if you're setting up an organization, you're trying to build the capacity of the nonprofit. You're trying to set up the infrastructure and utilize everything. And so you've given us some great tips today. So on behalf of myself and Kayla, our VP of Community Development, and the whole Sports Philanthropy Network, we want to thank you for coming on. And we appreciate everybody's time. For all of our viewers and listeners, we hope that you'll come back for some of our other webinars. We've had a great array that's already posted on the site, and we've got more coming up. So thank you very much for joining us today.